Joining us again for another one of these weekly live streams Monday mornings, every Monday at 9 a.m. Try to come to you live to get you ready for the week, talk to you about what to watch in stocks for this week, the stocks I'm watching and stocks I'm buying, and kind of try to make sense of this market and try to make some money. Great live stream for you today. Going to talk about, obviously, again, what stocks I'm watching, what the stock market is going to bring this week. Had a huge week last week. Market was up 8%. The NASDAQ was up 8%, which is ridiculous. It's unheard of for an entire index of stocks to be up that much. I saw some ETFs up more than 25%. I think the ARK-K was up 25% in 1 week on a rebound in those stocks. And it really does say something about the sentiment in the resilience of the sentiment in the market, right? Investor sentiment, their willingness to buy the dip, and unwillingness to give up on this market, right? After about 5 straight weeks of declines, of losses on the major indexes, investors were still there to buy the dip and get a little bit more positive on stocks. So we're going to talk about that and why that's important. And one of the reasons why it is important is because I think it really shows that you can kind of guide your investing strategy around some of these ideas and long-term concepts that we talk about on the channel. Because for anyone that's been following the channel or the live streams here, it wasn't totally a surprise, right, that we got that big boost last week. For last month, really, maybe last month and a half, I've been talking about that idea that we could see a relief rally in March when the Fed does start its interest rate hike, which we got that first interest rate hike last Wednesday. And the idea was here, based on learning what I've learned over 20 years as an investor, over 10 years working in the industry as a venture capital investor or venture capital analyst, then with private wealth management and as an equity analyst, learning over that period, kind of those investor behaviors, right? How investor sentiment is guided by some of these events that we see unfolding. And you really can kind of, I don't want to say time the market because that's got a lot of baggage behind it, but you can really guide your investing approach around that. That was based on the idea that investors tend to either buy the rumor, sell the news, or sell the rumor, buy the news. Okay, and in this case, it was that sell the rumor. Right, because the market is forward-looking. It's looking at higher interest rate cycles that could slow down the economy, make the cost of borrowing higher, make those longer term duration stocks like growth stocks and tech stocks more, less valuable. So it was selling the rumor. It was selling the lead in to those Fed rate hikes, right? And of course, what we usually see with that investor behavior is the tendency to sell the rumor, buy the news. So when that news actually happens, when we get those first rate hikes, the market says, okay, you know what? 0.25% increase in interest rates is not going to derail the economy. Okay, you have to get up to 3 or 4% on interest rates before it starts really affecting the economy. 0.25% or nothing, the economy is still going to grow. If we don't get a blow up in some of these other situations and events like Ukraine and things like that. So the market has a collective sigh of relief and bounces higher on that buy the news, okay? And so that's one of those things that you can actually, predict with market and with investor behavior. And some of these other things you look at, the business cycle, how the different businesses and industries react to increasing interest rates, inflation, some of those other economic factors. Those major long-term trends that we've been looking at, those mega trends like demographics, as well as AI and innovative tech, things like that. Those are the things that you can guide your investing strategy around. And I think it's a very powerful concept that only leaves those unforeseen events, the black swan things like geopolitical risks, right? Like a war breaking out, fraud and natural disasters that you can't really guide your investing decision around because they're unforeseeable. So you really just have to hedge for those kinds of things. So you can change up your investing procedure. Even buy and hold investors can change up their investing strategy to maybe shift more towards cash or less towards cash, maybe shift more towards riskier stock sectors or less, depending on these things that we talk about on the channel. So, really great perspective, great ideas here, and we're going to talk more about that later. I do want to give you a heads up before we really get started here, though. I get asked all the time if I do private one-on-one coaching, consulting, or portfolio consultations, and I always have to say no. I just, with the workload, getting the videos out, getting the analysis done on all the stocks that we cover here on the channel, I just don't have time to do that kind of one-on-one coaching and consultation that I used to do with private wealth management, right? But starting here next month, this is exciting. For the first time we're doing this, is I'm actually going to be starting a mastermind group. We're starting the Bowtie Nation Insiders Mastermind group. It's going to be 8 90-minute calls over a 3-month period, right? So we'll be running a different group every 3 months. It'll be 8 90-minute calls over that period. Each call is going to have a learning presentation. So I'm going to prepare a learning topic around, and it'll be different. We'll have 2 groups. We'll have one group for very beginner investors. We'll have another group for more experienced, advanced investors. For this first group, this first advanced investors group, we're going to be talking about things like portfolio management, risk management, portfolio construction, stock analysis, financial statement analysis. So really digging deeper into what you usually get in videos here on YouTube about actual stock picking and investing. That financial statement about analysis, options investing, active investor strategies, the real part of investing that you don't see here on YouTube and that I used to do as a venture capital analyst and in private wealth management. So we're going to be doing that. Now it is only going to be open to 15 people. Okay, I have to limit this because I want that one-on-one interaction, right? These groups are going to be 15 people. They're going to be 90 minutes long. We're going to have time for roundtable discussion, for Q&A, and we'll also be having a chat room for different concepts and as well as the real-time stocks I'm watching and buying. I'm going to post in that chat room. So I am opening applications to that group. I'm going to leave the link in the chat there. And again, it will only be limited to 15 people. Application is going to be open for about a week here, and I will have an early bird discount code to give everybody once they get started here. But 15 people because I really want those groups to be small, to have that interaction and that engagement that I always liked getting with when I was working private wealth management. I want to get started here today, though, because it does look like it's going to be a little bit a slightly lower market. Let's change this up. It does look like the market is going to open slightly lower this week. Of course, negative 0.3% on the NASDAQ is nothing when you consider that it grew 8% last week. So, I want you to put that into perspective when you see the market down this week, that, hey, you got to expect a little bit of give back anyway. S&P 500 was up 6%. The Dow was up 5.5% last week. And again, that is unheard of for an entire market index to be up that much. And again, I think it's very supportive of the investor sentiment and that willingness to buy back into this market. And I think that sentiment should carry us over into next week and even a couple of weeks. The NASDAQ is still down 14% from its high of last year. So we still have room to run higher. Stocks are no longer that expensive compared to the on a price to earnings basis. In other assets here, oil is up this morning, up 4%, back up to $109 a barrel. Was down slightly it was down to below $100 a barrel last week. Rebounded back up to close at $105 per barrel. Gold fell 3.5% to $1,992. It's down again today, to start off this week at $1,925. I would not be a buyer of either of these right now. Okay, so we've been talking about this price of oil, price of gold over the last couple of weeks, and these are both completely dependent on the Ukraine situation, which of course is unknowable. Now, I do believe we still probably have another week or two before President Putin and the Russian government is really in that position that they have to negotiate, and they're serious about negotiating. So I do think, we get another couple of weeks of the news on that Ukraine situation before we get any kind of positive positive progress on negotiations. But of course, you can't know that. There is no way to know exactly how that's going to come out and when those crude oil prices are going to crash down lower. Because if we do get some kind of resolution or even talks, serious negotiations or of a settlement here in Ukraine, then you're going to see crude come down. You're going to see gold come down. Okay, it could get worse. It could get. We could hear that Russia is going to be kept from putting its oil on the global markets. That would send crude back up to $120, $130 a barrel. So it could go very volatile either way here, and I just don't think you can really know what that's going to do. Now, if you are in the futures market, if you're doing some kind of a strangle where you benefit from that volatility and not necessarily on the prices itself, then it might be a trade. But of course, that is for only very experienced investors. Again, what I would be looking at, as we've talked about over the past couple of weeks, is the producers of these things, the oil explorers, the gold explorers. Okay, even if prices come down quite a bit, those explorers and those producers are still cash flow machines. Okay, they're still making a lot of money. We're going to look at what the energy stocks did last week. They were actually down last week, and I do expect some profit taking after about a 33% run this year so far. But those companies, those energy stocks and those gold producers, those gold miners are still cash flow machines. So I would be watching those instead of the commodity prices themselves. Bitcoin rallied to 41,500 last week. It's actually down around 41,000, but very resilient around that $40,000 level. And we're going to be talking about more of that later. I think if we do keep seeing stocks run higher this week, as I think they will this week and next, barring any kind of an escalation of the Ukraine situation, I think investors are going to come back into the market on that relief rally after the Fed rate hike started, and you could see Bitcoin rally back up to test those $45,000 levels this week. I want to look at the sectors now, how the sectors did. And of course, as always, this is the sectorspider.com. Great resource tool. You go here to the Sector Spider, you go to the Sector Tracker, and you can really pick your time frame here. One day, we've got 5 days to look at what happened last week, but you can look at year to date and 1 year. And this is going to give you that great top-down overview picture of how the market is doing by sectors of the economy. Here we see last week the S&P 500 did close higher, almost 6.2%, which is a huge move. And in kind of an ironic twist, okay, for the last few weeks, it has been the energy sector has been the only sector that has been closing higher, right? This energy sector right here, the stocks in that sector, over the last couple of weeks has been the only sector a lot of times that has closed higher because of those higher oil prices. Well, last week it was just the opposite. Last week we got a rebound in all these other sectors, and then it was energy that fell 3.9%. It was also interesting that even though we had that switch to a risk-on market, the safer sectors like utilities and consumer staples also rose, not by quite as much. Utilities was only up 0.5%, consumer staples up 3.8%. Normally, you would see those are kind of counter market or basically, when you have that risk on market, then those fall. When you have a risk off market and people seek that safety in utilities and the consumer staple stocks, then those rise. But it just really shows you the bearishness the market had reached, that even those sectors had sold off so much and were due for a rebound. Okay, technology and consumer discretionary, of course, led the performance. We had 9% up in consumer discretionary. One of the sectors we've been talking about, the consumers are still very strong as of yet, and I think those consumer discretionary stocks do continue to do well as the market rallies. I would be very cautious, though. One thing you have to remember and have to understand here is be very cautious on these retailer stocks. So a lot of the stocks in the consumer discretionary sector, okay, these are the things, and we can actually look at some of these, what these are. You've got within that, you've got some of the drug makers, Moderna, kind of an outlier here, but Etsy, United Airlines, that's not these. For some reason, it didn't switch to the consumer. Okay, here we go. Here's the consumer discretionary. These are companies that sell things that you really don't need, but you buy anyway, right? Things like, Tapestry, eBay, Ralph Lauren, Carnival, even Tesla is a big part of that index. But, you look through some of those, and they should continue to do well. They had sold off very much over the last few weeks. But as we go into that consumer price index report for the month of April, okay, it's going to report March's price increases. Usually comes out on the week of the 12th, right? The week of the 12th, so about the second week in the month, next month, that number is going to be shockingly bad, okay? And of course, economists are predicting that, they are forecasting that, so it won't be quite the news that it was, but it is still going to be very bad. It could actually be double-digit inflation over the last year to March, okay? And of course, that is because that's going to be the first CPI, the first consumer price index release that we see that real big jump in gasoline prices and in oil and some of these other prices. Okay, and it's not just oil, folks. Wheat, soybeans, a lot of these agricultural commodities have increased pretty significantly as well as nickel and some of the metals. So I think you start to see the effects of Ukraine come through on inflation here this next month. That CPI, that consumer price index, is going to be very bad, going to be very high. And I think it could be another sell-off in the market, another inflation-driven sell-off. It's going to hit those consumer discretionary stocks the hardest because people are going to start wondering, okay, how strong is the consumer really? Okay, if gas prices are going up, 40 and 50% over the last month, how much are consumers really going to have left over to buy some of these other products that they don't necessarily need, but they buy anyway? So I would be cautious about that consumer discretionary sector heading into that CPI report for next month. Again, like we talked about the energy sector, you would expect some profit taking here. It's still up 33% for the year. Energy stocks, we can actually go out to the 1 year or to the year to date one, and you see here, how bad the sell-off has been, even up to last week. Energy stocks are still up 33% for the year. It is the only sector in positive territory with those stocks. S&P 500 still down 6.4% so far this year, even after last week's 6% increase. And you can see how it's affected some of these individual sectors. Communication services actually down the most, and that communication services, that's kind of a Frankenstein sector, right? Communication, it used to be the old telecom sector, right, with just the telecom names, a little bit more stable, a little bit more like a utilities sector, but then they added a lot of these internet names, okay? A lot of the, Activision, Blizzard, Electronic Arts, Alphabet, a lot of the social media names like Alphabet and Amazon, or Alphabet and that they added to that communication services sector. So it's really kind of hard to tell on that alone. You can click here and see the largest weights. So you got Facebook, you got Google, you got Activision, Blizzard. You still have some of those telecom names like AT&T and T-Mobile, large parts of that index. But again, a lot of it is those social media platforms. So, those are going to be hit harder, obviously, than the telecom names when the stock market falls. And that's why that communication services sector is down so much so far this year, 12%. It's really been in the sell-off on those social media stocks, especially Facebook. Man, look at that, down 35% so far this year alone. Again, consumer discretionary has also been hit hard, second worst performing sector of the 11. And we've got worst performers here. Etsy, 32% down. Bath and Body Works, Domino's, General Motors, all down double digits there. And you can kind of scroll through here and see what stocks in the S&P 500 are in each of these. And it's really descriptive of how that sector of the economy is running, how investors feel about that. Again, like we said, energy is still up 33%. You would expect some profit taking to continue if the rest of the market really looks that rally continues and people get pulled back into those tech stocks, into the communication services stocks, into consumer discretionary. You would expect them to come out of the energy stocks, even if energy prices are still stable around $105 or $110 a barrel. Then you'd expect some profit taking on there. But again, even if oil prices come down a little bit, these are still cash flow machines. So I would continue to watch these throughout the rest of the year, especially for those higher dividends. I continue to like Chevron, CVX in that mega cap space, one of the best oil producers out there, very low cost oil producer. So they're making a lot of money right now, as well as some of those shale drillers like Diamondback Energy, that's ticker FANG, and Devon Energy, ticker DVN, are all really good, really good oil names to watch there. I want to talk about, kind of just what I'm watching. So what I'm watching for the week, kind of get you ready for the week, some of the stocks I'm watching, and then we'll head on into some topics. Again, barring any kind of deterioration in Ukraine or escalation of that, investors should see a continuation of the relief rally that started last week. Okay, as we said, the S&P 500, that broad stock market index, is still down over 6% so far this year. The NASDAQ is still down over 14%. So there has been a massive sell-off in that sell the rumor idea that we talked about as investors and the market sold off ahead of the interest rate hikes. Now we've got the buy the news, okay, that buy the news relief rally where investors breathe a collective sigh of relief. They say, okay, you know what, interest rates aren't that bad. The economy is still growing as of now, and the market is looking good. Okay, stocks are not so expensive anymore. We can get back into the market. So I think you still see that continuation of that rally, barring any kind of unforeseen news that we've talked about. Again, I would still be cautious going into next month's CPI, Consumer Price Index report. That's going to happen around the second week, around the week of the 12th, and that could be bad and could reignite those fears around inflation because that report is going to be bad. Again, there's no signs of serious negotiations out of Russia. Those sanctions are beginning to work, and some of the other things they're watching, but there's no real serious negotiations as of yet. It's still likely a few weeks before any real progress on settlement is made there, but and a chance that it does get worse before it gets better. So that's going to be kind of an unforeseen event that you just have to kind of hedge around and play the rest of the market. Something we're going to talk about later, Chinese stocks. Obviously, huge rebound last week. Shares of DD Global more than doubled. Shares of Alibaba were up about 50% last week. And I really think this is a turning point for a lot of these stocks. I would still be kind of pessimistic long term on what you're still going to have those issues of control and regulation with the Chinese government. But we've gotten some real signals from the government, as well as just, again, understanding those tendencies and those trends in the market that you can forecast, that you can look to get back into these. What's happening this year is there is an election this year. Okay, President Xi is looking to be reelected. Obviously, he's going to be reelected because he basically controls the government at this point. But there is still an election, and the party has to protect their local governments and leaders that need to be reelected as well. And what you've seen in the past, this is working out like the playbook from the past. Is you see that sell-off as the government tries to take more control and really mold the economy and keep that control on the economy ahead, like a year or 2 years ahead of those elections. But then that election year, things start to turn around, okay? Because no politician likes to look bad or likes a falling or weak economy going into elections, no matter how much control they have over the economy and over the electorate. Okay, you could have a complete dictator that doesn't even have to face elections, but has elections just for face value. They're still going to juice the economy during that election year to look better, to get those votes from the electorate. And that's really what we're seeing. Okay, we're seeing that turn into, if you look at past election cycles, then the market has been weaker heading up to those elections, up to a year before. But then that year or the 6 months ahead of the actual election itself, the market rebounds. Okay, and what we did start to see was that last week the government finally came to the conclusion that its regulatory actions against a lot of these tech stocks, against a lot of these other stocks, were really starting to weigh on the economy. Okay, these stocks were down 50 and 60 and 70% over the last year. It was really starting to weigh on sentiment. So they called an end to it. The government, through the official news organization, said they were going to hold off on regulatory actions. They were going to start winding those down. They were going to protect IPOs, foreign IPOs abroad of stocks. And that's really where you saw that rebound. So, the Chinese central bank that has been pumping the economy for the last few months. Okay, it's actually one of the only central banks around the world that has been lowering rates, has been stimulating the economy because the economy has been in trouble. It has been weakening on those real estate problems as well as on the regulatory problems, things like that. So, the Chinese government is one of the few governments that is stimulating the economy. All the other governments around the world, the central banks, are raising interest rates like in the US. And I think that's really supportive of these stocks for the rest of the year. So, I know a lot of people have kind of ideological problems with investing in stocks of Chinese companies. I'm actually invested in Alibaba and DD Global at this point. DD Global is much more of a short-term kind of investment that I picked up before the big increase last week. Alibaba is a little bit longer term. I could hold that probably next 2 or 3 years and probably see a good double off of that. I'm up 35% just from last week, and I think it could easily go to $200 a share or more from there. First quarter earnings are going to be starting to come out over the next, in a couple of weeks. They won't be this week, won't be next week, but they will start coming out. And that's really where the market is going to turn its attention. Okay, expectations are fairly low right now. In fact, just 4.8% estimated earnings growth for companies in the S&P 500. So that is the lowest since the fourth quarter of 2020, which is extremely low considering the last couple of years, actually, we had full year earnings growth of 20% plus. Actually, it was like 30% earnings growth over the last several quarters. So a 5% estimated earnings growth for Q1 is extremely low. Obviously, companies are going to be able to beat that. We'll have to see how much. The interesting thing here, though, when you're watching earnings come out over the next few weeks, is that revenue growth is expected to be much stronger at 10.7%. Okay, and that's on a year-over-year basis revenue. So sales at these companies in the S&P 500 are expected to grow almost 11%, but that's only going to translate into 5% earnings growth. Okay, so what you understand here and what this says about the market is companies are increasing their sales. They're increasing their prices on their products. They're still getting that good sales volume. So their sales are going up. But they've got all these costs that are coming in, and they're hitting, the supplier costs, the production costs, the wages that are going up. All that is taking out of these sales more than usual, more than it usually would be, and they're only converting 5% of that revenue, or 5% growth from a 11% sales growth. Okay. Which is really interesting because usually what you see is the opposite. Usually you see a little bit lower sales growth, and then earnings growth is above that because companies are able to leverage that up with with debt and with some other economies of scale and efficiencies. Okay, so this is a little bit different. Sales growth faster than earnings growth. And what I think you really need to see from this and get from this is how companies are reporting different profitability margins. Okay, very important here, especially as we see inflation head higher. Then the companies that are able to manage these inflationary costs, manage this inflationary environment, are going to do much better. Okay, those are going to be the quality names that you want to be in over the next few months, over the next year, is those companies that are able to do that. And there's two margins, there's two numbers that you want to watch for in these. These are something we've talked about on the channel before. First is the gross margin. Okay, and I actually want to take you through this so I can show you exactly what I'm talking about. So here's Nike, for example. You can go to any stock, and if you go to financials here on Yahoo Finance, or if you go to their financial statements, and you go to the income statement, okay, this is the statement that shows all the sales, all the costs, and the earnings of a company. And you can go through here. And what you'll see here is on the top of the income statement always is that total revenue, total sales number. Okay, then you got the cost of revenue. This is the cost of paying their own suppliers, the things that go into their product, the things, some of their production costs, things like that. And then you have the gross profit. Okay, and the gross profit is whatever's left over of their total revenue, of their sales, after paying those production costs, the supplier costs, things like that. Okay, and if you divide this gross profit divided by total revenue, then you get a gross profit margin. Okay, a gross profit number. So we'll do 21,283 divided by 46,306 for Nike. So Nike over the last year had a 46% gross margin. Okay, that is their profitability after paying suppliers, after paying some of these production costs, things like that. Now, what you want to do with a lot of these, and we'll look at another margin here in a little bit, but what you want to do is you want to compare that for the earnings coming up. So the Q1 earnings where those inflation problems are really starting to hit in Q1, in the Q2 of this year. And as we go forward, those inflation problems are really going to start hitting companies. So you want to check these with what companies are saying is their gross profit margin. Okay. And you want to compare that against, over the last year in 2021, you want to compare that against the past. So let's look at what Nike did. We had a 46% gross margin over this last year. What did they do in 2019 before inflation really started to be a problem here? So 17.47 billion divided by 39,117. So they had a 45% gross margin there in 2019. And you'd want to check this, different years, different quarters, things like that, just to get a good sense of the trend in that gross margin. So it does look like that so far, over the last year, inflation hasn't been a problem on this gross margin measure for Nike. They've been able to raise their prices enough, pass on those costs to customers, so they've been able to keep that gross profitability. You also look here at the operating income. Okay, so after gross profit, you've got all the operating expenses, and these are things like selling, so marketing, your general administration, a lot of your wages. So there's really two components of inflation that we're seeing really increase. Okay, one is suppliers. Okay, things that go into a product, you have to pay for supplies to create that product. That's going to be in the cost of revenue. So companies that are having problems negotiating with their suppliers, really pricing power over their suppliers, you're going to see it in this cost of revenue. This cost of revenue is going to explode for companies that don't have that pricing power with their suppliers. Now, the operating expenses, that's going to be a lot of the wages. Okay, so the wages for things like fast food, McDonald's, Starbucks, a lot of your manufacturing companies, a lot of the companies that are seeing those highest wage increases. That's where you're going to see this operating expense explode higher. Okay, the out of control increases in inflation there, and that's what you want to look at with this operating income number. Okay. So again, with the operating income, you can do the same thing. This is the amount of operating profits after paying first these costs of revenue things, and then your operating expenses, your R&D, your wages, your marketing, things like that. So if we look here, 7169 divided by total sales, it's always over total sales. So 46,306 is a 15.5% operating margin for Nike. And if we go back here, we can do the same thing here with 2019. So 4772 divided by 39,117. Okay, and then we see this is amazing. This is really interesting. Nike, its cost of its gross margin. Okay, the thing we just looked at, this gross profit divided by total revenue. So that gross margin, that gross profitability after paying suppliers and production costs was pretty consistent. It held at right around 46% all through these years from 2019 to the last 12 months. So there didn't seem to be a problem with inflation in those supplies, production costs, working with suppliers, things like that. That tells me, obviously Nike has a lot of pricing power with its suppliers. It's going to go to the suppliers and say, you know what? I know your costs have gone up, but you're not going to charge me because I'm Nike, man. I almost said I'm Nike, bitch, because I can always source from somewhere else. And you're not going to charge me more. So Nike has a lot of pricing power over its suppliers, and it's been able to keep that gross profitability up pretty high. Operating income is a whole nother story though. If you look at what happened here, operating income, operating profitability. Okay, so that operating margin, the operating profitability was 12.2% in 2019. It is now, what did we see here? We saw 7169, 46,306. It is now 15%. Okay, so that's interesting that their operating profitability has actually increased over the last few years. Okay, so that tells me that they've been able to keep those wage increases down. You really want to watch this though. Watch it for the next couple of quarters to see if their wages start to spiral higher and what happens to that operating income. So gross profitability has been pretty stable, but they've been able to increase their operating profitability, their operating margin. So that's what you want to look for in that. And I know it was kind of a long aside to what we were looking at there, but you really need to watch those two profitability numbers going into this first quarter to find those companies that are able to maintain that profitability, okay? Because it's going to be the real distinction between companies in this inflationary environment. As inflation really heats up, and I think it's only going to get worse before it gets better, you're going to find that real difference, that real distinction between stocks of companies that are able to manage those inflationary pressures, are able to keep their own costs down and raise prices, versus the companies that their prices are going up, but they can't increase their own prices to cover those costs. So something you definitely want to watch. Want to look at some of the stocks that I'm watching this week. We will go back to looking at Nike here, because they are expected to post earnings Monday, actually, and so we'll just refresh this to see how it opened on the market. So market is flat with Nike. We'll go back to Nike here. See if that's moving any on the earnings. So Nike is flat, pretty well flat, or market performing today. It's expected to report earnings today, and though I don't have a position in Nike, actually, it is a great indicator for retailers and really the general health of the consumer. Okay, obviously, Nike is a huge consumer brand. Everybody loves the swoosh. I've got Nikes myself, so you really get a good sense of how their sales are going is really kind of the health of the consumer and the consumer going forward. So whatever they say for that first quarter earnings report is very important for consumer spending. Earnings estimates have come down significantly over the past 3 months as analysts really try to get a picture of how that inflation is going to affect retailers. And again, we've seen this across a lot of stocks. Analyst expectations and earnings have come down for the entire market because of that inflation and because of the fear of an economic slowdown. I also want to watch NVIDIA this week. NVIDIA has its Investor Day Tuesday, so it's going to come out. It's going to say, going to talk about what it has in store for the future, how it's going to impress investors, and it really does need to impress investors if it wants to keep up that kind of momentum, especially from last week's rally. Okay, shares were up 24% from Tuesday of last week for NVIDIA. But even on the sell-off over the last, for really the year to date, this stock is still trading for 20 times on a price to sales basis. So very much a growth stock. That growth territory, still trading for very expensive valuations here, 20 times on a price to sales. So management really does need to come out with its Investor Day, reaffirm that guidance on growth. And it's going to be a tough story to sell. Any pessimism on the outlook, like we've seen from a lot of other growth stocks, could weigh on these shares. Okay, so I would be watching that. NVIDIA is going to have to impress, going to have to keep on that growth persona, or things could get ugly again. KB Home is expected to report earnings on Wednesday. Shares earnings are expected to be very good, up 50%. In fact, over the same quarter last year, earnings of $1.54 per share expected on $1.5 billion in sales for the quarter. It was a really strong quarter, but obviously, what we've been seeing is it's more important what management says about the rest of the year. Okay, this isn't just those growth stocks and tech stocks, but all the stocks. Really, investors are more focused on what management is saying about about going forward, especially this year. Any kind of negative changes to the outlook could cause a sell-off here, could cause it to reevaluate the stock price. And frankly, for home building, that's KB Home. It's a home builder. Surging interest rates for the 30-year loans are now up beyond 4%. Okay, already high home prices. It's not going to help the market. So it's going to kind of, it's difficult to see how management of KB Home could put a positive spin on this, because obviously real estate, the home market is weakening. So I want to see what they say about that and how, make sure they're not going to throw cold water on the party for this stock. Again, watching Alibaba, it is down 5% here today, just kind of a bounce or a profit taking off of last week's huge move. We can see what it did last week. So, it closed down to a lower about 75 on Tuesday, rebounded to 110 by the end of the week. So that is more than a 40% return just in the last week. So you would expect some profit taking here in those shares. But I would be watching those. The Chinese government really doesn't make these kinds of pronouncements like, hey, we're going to be more supportive. We're going to try growing the economy. We're going to ease off these regulatory concerns. They don't make those kind of pronouncements and then back down from it. Okay. They are very much they're going to think out these things before they make them, and they're going to stick with it. Even if it's a bad, even if ends up being a bad decision, they're going to stick with that decision for quite a while before they reverse course. So I think that announcement last week that the Chinese government was going to back off regulatory crackdown, it's going to be more supportive of the stock market. I think that's something you can really take at face value and work into more of these stocks. So now I do want to turn to crypto for a little bit and just kind of talk about what we're seeing there. And it's every week that we're seeing more skeptics of Bitcoin, of cryptocurrency, reverse course, start investing. The week before, it was the Ken Griffin, billionaire investor, founder of the Citadel Securities hedge fund. He has long been a critic of Bitcoin, said Bitcoin was a jihadist call against the dollar. And just, over the last couple of weeks, he's come out publicly in an interview, admitted he was wrong. And, it takes a lot to admit you were wrong on something for so long. But he has admitted he was wrong and is now investing in Bitcoin. Last week, the bond king, the king of bonds, Bill Gross, another one of the very prominent crypto critics over the years, has said a lot of things about crypto being a bubble or worthless, things like that, is also now investing in Bitcoin. So a lot of these skeptics coming out, actually doing the research like I did, a little over a year ago to understand what Bitcoin is, what the blockchain technology is. And I think that's really what you start seeing here is, like myself, I was a big skeptic of crypto, of Bitcoin back in 2017 when it was raging higher. I did a few videos, saying that you would be sorry if you invested in crypto, you would lose your money, and that was before I actually took the time to not analyze, the true value and the intrinsic value of Bitcoin, of some of these other cryptocurrency tokens like Ethereum. So what I think you start seeing these crypto skeptics actually do the research, do their homework, and they're coming over. So, really the question is for the remaining skeptics out there, do you want to be the last skeptic to invest in Bitcoin or to take a position? This is a legitimate asset class. Nobody's can kill Bitcoin at this point. Okay. You've got countries making Bitcoin legal tender. You've got countries not necessarily making it legal tender, but recognizing the value and recognizing it as a store of value legally, so in a regulatory environment. So no single country can fight that. Another thing that we continuously see is U.S. states really trying to position their state and their economy to attract those that cryptocurrency, technology, the blockchain technology, the companies, the miners, things like that. Colorado has been very forward on this. The governor comes out and says he wants to be a haven for crypto as a basic convenience thing. A lot of states lining up to be able to let their constituents pay their taxes and pay other bills, state and local government bills, in cryptocurrency and in Bitcoin. So what you see is, a lot of positioning. Texas, Florida, even New York is positioning to attract Bitcoin and cryptocurrency investors as well as companies. And so you get to a point where it cannot be killed. 16% of the U.S. population, 24 million people in the U.S., 300 million globally invest in cryptocurrency. No party, no government wants to be the one that tried to kill Bitcoin. Especially with elections as close as they are. So, again, if nothing kills Bitcoin, which nothing can, then it's only going to grow in value. It's only going to attract more investors and more money into that asset class. So I really do think, you really want to take the time. If you are still a skeptic, take the time to research the intrinsic value of cryptocurrency, of Bitcoin, where that value comes from. We've got some videos there on the channel that you can watch as far as the valuation, where it comes from. It's not just it's not just as a store of value or as an investment. There are some real intrinsic values there for Bitcoin. One more thing here before we hit to our Q&A portion of the live stream. I do want to check out the FactSet analyst targets by sector, and of course this is FactSet Earnings Insight. You can find this anytime you go to if you go to Google. I'll show you how to find this real quick because it is a great resource for earnings and for stock market analysis. You go to FactSet Earnings Insight. Okay, you can see it pops up on the on the drop down for me because I use it so often. So you search for FactSet Earnings Insight and click there, and it's always going to be the first one. It's always going to be this PDF is the first one. And what this shows all the earnings estimate, how earnings for companies in the S&P 500 are coming out. They've got a lot of great graphs here as far as, the price to earnings ratio. And this is really interesting. If you look at the price to earnings ratio, so the price of all the stocks in the S&P 500 divided by the earnings, okay, the earnings that they've made over the last year here with this trailing 12-month PE ratio. And you can see after that huge drop so far since November of last year, November, December is when that stock market sell-off started. The price to earnings ratio of stocks in the S&P 500 in that broader market is pretty much down to that 10-year average, which is really amazing. It was so high. It was up to about 35 times on a price to earnings basis, way more expensive than it has been over the last 10 years and really throughout history. But it has now come back down to that average. So stocks are not expensive here. Even after last week's very big rebound, stocks are still not expensive, and that's very supportive of the market going forward. What I want to do, though, I want to scroll down here. The last chart they have in the research report, this is always the sector level bottom up target price versus the closing price. So what this is each sector of the economy. So you've got the 11 sectors, things like technology, consumer discretionary, the financials, materials, energy stocks, things like that. And then the S&P 500, the market itself right here. And this is analyst estimates for the target prices of all those companies in each sector and then in the market itself. Okay, so analysts, they survey all the analysts on Wall Street, say, hey, what's your target price for all the stocks in the S&P 500? And then that versus the closing price. Okay, so what you got here is a return expectation. How much analysts expect the return to be on each sector and the S&P 500 over the next year. So this is really instructive in two ways. One is you can actually just see where analysts expect to get the best returns over the next year. And here we see, okay, so in the communication services sector, the analysts are expecting a 33% return over the next year. And I expect a lot of that is in those social media and technology internet stocks that are in the consumer services sector. Again, if you ever want to see what stocks are actually in those sectors, you go back here to the Sector Spider, the sectorspider.com. You look at the sector tracker, and you can click on any of these and see what is in those sectors. Okay, so again, we go to this communication services. This is going to be your media companies, your telecom companies, your internet, some of your internet companies, as well as social media. Okay, you've got Google, you've got Electronic Arts, Paramount Global, Activision Blizzard, a lot of those. So you kind of get a feel for what stocks analysts expect to do really well over the year, and 33% increase. And again, I think this is based off of analysts still have pretty high target prices for a lot of those social media stocks, for some of the internet names, things like that. And so they're expecting a strong rebound there. They're also expecting a 26% increase in technology stocks. Consumer discretionary up 25% expected over the next year. Okay, so you really get a sense of what analysts are thinking. Analysts are thinking that things are going to rebound, that the economy is still going to grow. They're thinking, obviously, if they expect consumer discretionary stocks, so stocks of companies that sell things that we really don't need but we buy anyway, those retailers, things like that. If they're expecting a 25.5% return in the stocks in that sector over the next year, analysts are saying that, we don't think inflation is going to be that bad or it's going to affect consumer spending. Okay, we still expect consumer spending to be so strong that the stocks in that consumer discretionary sector are going to jump by 25% over the next year. And that's really the second thing you need to think about when you look at a chart like this. Okay, you need to kind of question what this chart is saying about analyst expectations and what you believe as an investor, okay? Because, I have a hard time believing that with the inflation that we're about to see, the inflation of 9 and 10% come out on that consumer price index because of gasoline prices, I have a hard time thinking that consumer discretionary stocks do 25% over the next year, okay? With what we know about some of those social media stocks in the communication services sector, like Facebook, like Twitter, they are still being held back by that change in the Apple privacy as far as their ad revenue and their ad targeting. I have a hard time thinking that those rebound so much that sector does a 32% return over the next year. So what you really want to question some of this, okay? So you can take some of this at face value. You can go to these communication services stocks and say, okay, which are my favorite? If analysts believe that it's going to run 32% over the next year, which are my favorite? Maybe I buy a few of those stocks. But you also want to be a little critical. You want to look at these and say, you know what? I don't know if that's going to happen. I want to look on the other side here. Where do analysts think that the returns might not be so great? Healthcare. Analysts are only expecting an 11% increase in healthcare over the next year. So, with demographics, with people getting older, with people using more healthcare, with the healthcare, sector maybe rebounding from a very hard pandemic. Healthcare actually did very poorly during the pandemic because they couldn't do a lot of those high profit surgeries and electives during the pandemic. So if you believe, maybe we're moving on from the pandemic and healthcare companies are going to be able to return to those higher profit services, maybe healthcare does better. They're also saying utilities. Utilities only do 5.7% over the next year. Energy, only another 10%. Now, energy, it's a tough one because energy stocks have risen so fast. You really got to wonder how much gas is left in the tank there on those energy stocks. But you look at some of these other industrials, materials. If the economy does keep on growing, you're going to see it here in the industrials and materials, and they could do better than this 15 and 14%. One I'm really watching here, the financials, okay? And that's the financial sector. That's going to be a lot of your bank stocks. That's going to be your insurance companies, your asset managers, but specifically your bank stocks. If interest rates do keep rising and if that yield curve stays positive, then the bank stocks are going to start making a lot of money, okay? And so I think you're going to see a lot better returns than 15.7%. For the sector out of the financials. So that's one place where I would think maybe analysts are a little bit behind on their expectations. As a whole, we can see here the analysts expect about a 20% return over the next year for the S&P 500. So just some things to think about. A great resource there with the FactSet Earnings Insight. So check that out. But always be skeptical. Always be critical of what you're seeing. Understand what it says about analyst expectations, and then what you believe as an investor. So I want to turn this over to the question and answer period. Love this part of the live stream because it lets me connect a little bit more with you out there in the community, in the Bowtie Nation. So I want to scroll back up and see what we have. What we have as far as questions there. First, I see Ivan can't super chat from Russia. That's totally perfectly fine, man. Ivan's been a long-time member, citizen of the Bowtie Nation. Great guy. Actually talked to him, through emails and privately before. So, don't worry about that. No problem at all. Why do you prefer Bitcoin over investing in Bitcoin miners? Great question. Great question. And I know you prefer investing in gold miners rather than investing in pure gold. Okay. So Bitcoin over Bitcoin miners. Something very different than that idea of gold miners over gold. Okay. Because, gold, you invest in gold, the physical asset itself, or the futures, the commodities, some of these ETFs that invest in gold, you get no dividends. You get nothing until you actually sell that and get that return from gold. Okay. Plus, gold has a carrying cost. Gold is, as interest rates increase, that tends to decrease the price or the value of gold. Okay, because you get no profits holding gold. Then there's an opportunity cost, a cost in interest rates. Okay, as interest rates go up, investors there in gold are saying, you know what, I can get the treasury, I can get the risk-free treasury, I can get some bonds of companies like AAA rated companies that are just as safe but are paying me this interest rate. So as interest rates go up, it draws people out of gold. Okay, it draws people out of gold and really limits the valuation on gold. Okay, so One of the reasons why I really don't like investing in gold, not just because of the price. The price right now, it is very, very expensive. Gold right now, I think it does come down into that range once again. But for Bitcoin and Bitcoin miners, though, it's a little bit different story, isn't it? Right? The Bitcoin miners, they don't necessarily, most of them don't pay dividends, so you don't necessarily get those dividends. The Bitcoin miners, I haven't really looked into what their what their costs are as far as producing those bitcoins, and what their profit margin is. A lot of what we talk about with gold miners and gold is that the gold miners all in sustaining costs. That's the AISC, and this is something you want to check with all gold miners when you invest. That AISC is for the industry is right around $1,200 an ounce. Okay, it's actually up to like a 7-year high. Okay, so the cost of production for gold very high right now, but it's still, even at $1,200, is still way below the $2,000 per ounce price. Okay, so these miners are just cash flow machines. They're printing money, digging it out of the ground. Okay, so that's why gold miners, even if the price of gold comes down, should still do well. With Bitcoin miners, I'm not so sure. I don't know what their cost structure is and how much profit there is between the current price of Bitcoin and how much it costs them to produce. A bigger reason, though, why I really like, investing directly in Bitcoin or some of these other cryptocurrencies rather than the miners, rather than Coinbase, is because it's really kind of a win-win situation for cryptocurrency and a win-lose situation for the miners and for Coinbase. Okay, so what you got to understand is all the miners and all the platforms, Coinbase, FTX, Binance, BlockFi, all of those depend on cryptocurrency to do well. Okay, if Bitcoin doesn't do well, if Ethereum, if all those cryptocurrencies don't do well, the miners and the platforms aren't going to do well either. They're going to crash, okay, because that's their only business model. Okay, so they need Bitcoin to do well. Bitcoin does not necessarily need any of these individual platforms or miners or companies to do well. Okay, so if Bitcoin goes up 50%, Coinbase is probably going to do well. The miners are probably going to do very well. Granted, but they might not. You could have fraud, you could have scandals, you could have just poor management at any of these single companies, any of these individual companies that could crash the stock, even as Bitcoin does well. Okay, so Bitcoin does well, and maybe you get good returns off of some of these others, these miners and these platforms, but not necessarily. For the miners to do well, I mean, Bitcoin does poorly, you're going to do poorly in these as well. Okay, so I say, why not just go directly into Bitcoin, directly into cryptocurrency? You're going to do well either way. Okay, so that's really why I'm not in the miners, the Coinbase, a lot of these others. We've talked about Coinbase before. They really need to diversify outside of just those fees. Okay, fees on Coinbase are some of the highest on exchanges. Coinbase Pro is quite a bit better. It's got quite a bit lower fees, but the main flagship Coinbase product is all Bitcoin fees, all trading fees. And, if anything like what we saw in investing with stocks comes down, if anything like that happens to cryptocurrency trading, then Coinbase needs those other products, because fees are going to come down on cryptocurrency trading, and it's going to destroy their revenues unless they're in some of these other products. They've been starting to announce NFTs and things like that. So a great question, though. Thank you for that question. So Ambrose, $5 super chat. I appreciate that. Thank you. Says IRM versus DLR, which is better? So IRM is a Iron Mountain. They are record storage, digital record storage, but really most of their money still comes from those physical record storage, right? So if you ever worked in a corporate building, a corporate office, or anything like that, especially accounting, where I come from, financial accounting and stuff, you see these huge boxes of physical files that get shipped off to Iron Mountain, right? Their file storage. Digital Realty is much more those data centers and digital products, digital data centers, digital data and things like that, digital storage, things like that. So two very different businesses. I mean, as far as REITs though, I mean, I love I come from real estate. I love those REITs. And I really like both of them. I like Digital Realty. I like IRM. We actually featured IRM, Iron Mountain, a couple of weeks ago in a dividend investing video. It's not going to make you rich. It is not a growth market. Okay, that physical records storage space is only growing at maybe 2% growth each year. Okay, so it's not making the company rich, but it is, that low growth means that there's no competitors. Iron Mountain is going to dominate physical record storage for as long as it's around. Because the profit margins are so low, nobody else wants to compete in it. So that cash flow from that segment, they're able to spin off and put into their growth of digital data centers, digital records, things like that. So it is a very slow growth company, but is very stable and very cash flow dependent. And I think the dividend is somewhere around 4 or 5% on that even. So it's a great dividend stock. Digital Realty, haven't looked at that one in a little while. I would be concerned. I would make sure you check the valuation on that, because those data center stocks can get very expensive, especially during the pandemic. People flocked to those kind of stocks, so it could be very expensive. So I would watch that. But generally, data centers are a growing part of the real estate market, and are only going to get bigger. So I like Digital Realty as well, as long as it's not as long as it is not too expensive. PSTG is still doing great. Thank you for that. Cool. I appreciate that. I was looking at Okay. What else? What do you think of Alphabet, Neo, Tesla, Disney? That's a lot. Adriana wants to know about every stock in the market. No, just kidding. What do you think about Alphabet, Neo, Tesla, and Disney? So we'll take a couple of these here. Google. Google, I really like Google. Some of those big tech names, those FANG names that have sold off over the last couple of weeks, especially Amazon and Alphabet. I think there's a lot of value in those. Again, I don't see them. I mean, obviously, they're not going to double like they have been over the past 5 years, but there's now some good value in some of these, especially Alphabet, Amazon, where you've got a lot of I think of Alphabet and Amazon kind of as lottery ticket investments, right? And this is different from what we talked about with Alibaba last week. But this kind of lottery ticket investment I'm talking about here is basically when you buy a share of Alphabet, when you buy a share of, which is Google, when you buy a share of that, or when you buy a share of Amazon, you're basically trading for those core parts of the business. Okay, with Google, you're paying for the revenue and the earnings from its search, from its YouTube, things like that, right? The really big parts of the company. What you're getting though is that plus some of these new innovative research technology that they're doing. Okay. If you look at the financial statement for Alphabet, for Google, they have, money invested in everything from self-driving to AI, to Internet of Things, really everything, as well as a lot of companies through Google Ventures, which is their venture capital arm of Google. They are investing in a lot of small companies, startup companies. And so what you really get with a share of Alphabet is, kind of a lottery ticket that some of these, like Waymo, its self-driving car unit, is going to just boom higher, is going to take off and going to be the thing of the future, right? So a lot of opportunity. You get that good valuation on the Google search as well as the YouTube valuation right now, and you get those lottery ticket things for that for the future. And that's the same thing with Amazon. They're really investing in the future with a lot of these things. What else? Okay, so you asked about Alphabet, Disney. Disney I haven't looked at in a while. I'll have to look at that over this next week and check that out. JD says, thanks for your time and energy, Leatherneck. Hoorah, brother. Thank you for that. What else? I'm going to scroll up here and see what we got for questions here. Okay. Joe, why QYLD keeps losing money? Okay, so Milkman Ed asks about the QYLD. Why does it keep losing money? And this is a great question. I'm glad you asked this, because this is a video we did last week. 5 stocks better than the QYLD. And I know I've recommended QYLD. That's the NASDAQ 100 covered call ETF. And I can show you that here, kind of talk you through what we're talking about here. QYLD. It's the NASDAQ 100 covered call ETF. And why it's losing so much money, and why I think you really do need to look at some of these other stocks that we talked about. Even though the QYLD, it's not a bad stock. It pays a 12% dividend yield, which I know has attracted a lot of people into that. And for that kind of dividend play, it's okay. But what you really have to understand, especially in this kind of market where tech stocks are coming down, it is going to underperform seriously. Okay, and it's does that in really 2 markets that makes it kind of a bad bet, kind of a bad investment. Okay, if you look at the 5 years here, It's done. It's pretty much been flat because of those dividends, right? It pays out so much in dividends. It's really hard for the asset value of that stock to head higher. And then since October, since the tech stocks in the Nasdaq have fallen, it's come down. Well, now it's down about 10%. It was down even more than that, but it's come down about 10%. Since October. And what you got to understand here is what this ETF is actually doing. Okay, so it's buying the Nasdaq stocks. It's buying the 100 largest stocks in the Nasdaq, that tech-heavy index, and then it's selling covered calls against those to generate that cash. So what happens here is, because it's selling those covered calls, as the Nasdaq just explodes higher, it's losing out on some of that upside. We can go here to the chart, and you can see this why it doesn't do very well when the Nasdaq is going higher. So we'll have the Nasdaq in red here over the last 5 years. Nasdaq in red, the QYLD in blue, and you can see how badly it's underperformed. Okay, the Nasdaq 100. So those tech stocks, those 100 largest tech stocks in the Nasdaq, 164% higher over the last 5 years, while the QYLD has lost 8% of its value. Okay, so that's really eaten into a lot of those dividend yields. That 12% dividend yield, you're not really making 12% a year because you are losing some of the value on your stocks. If we zoom out, and that's because they've sold those covered calls, so they've sold another investor the right to take those stocks away from them at a lower price if the stocks really take off. Now, year to date. Now we can go to year to date, and it does protect a little bit from some downside, okay, because it is selling those covered calls. It is a little bit of protection from the downside. Year to date, the QYLD has outperformed. It's down 7% against the Nasdaq that's down 11%. So it has outperformed a little bit. But again, you just got to understand what they're doing with this fund. Okay, so if tech stocks are doing really well, the QYLD is going to do well also. Those stocks, it's still holding those tech stocks in the market. It's not going to do quite as well as the Nasdaq, but it is going to do okay. As the Nasdaq comes down, it's going to protect you a little bit, but not from all those losses. So it is going to lose, and this dividend yield is just so high that it is going to limit that net asset value. It is going to limit the stock price on this stock. So I would prefer to go into some of these other stocks that maybe the BDCs or the mortgage REITs, things like that. Or even some of these regular dividend stocks that maybe not quite as high of a yield, but they do grow their share price. Okay, I just hate to sell something for less than I bought it for. And I know there's a lot of investors out there that say, I never sell a stock. I'm going to hold this stock till the day I die and just collect those dividends. Well, you think that, but then look at the stocks you actually do own. Do you own any stock for more than a year or 3 years or 5 years? Okay, the fact is that most people are going to sell their stocks within 3 to 5 years, 10 years at the most. Even if you hold stocks to retirement, then usually that dividend, even a 12% dividend yield, isn't going to cover your costs in retirement. So you're going to have to sell stocks. And it just really sucks to have to sell a stock for less than you paid for it and really see a lot of those dividends that you collected, kind of evaporate in that stock price. So that's really kind of what we're seeing on the QYLD right now. Okay, Milkman also asks, what do you think of the split in Amazon and Google? Are they good buys going forward? I'm really kind of agnostic on stock splits. They really don't change very much in the stock. I mean, basically, with so many platforms, so many investing apps doing fractional shares now, you can buy a share of pretty much anything. You could buy a share of Amazon, which is a $3,000 stock. You buy it with $50, okay? You just buy a fractional share of that. So it doesn't change very much anyway. It might bring in a few more investors that don't have that option of buying fractional shares. So that's a net positive, right? But it really doesn't change a whole lot as far as the stock valuation and that kind of thing. I would look, obviously you look more at that, just the valuation and whether you like the companies and their products right now. And again, I do like Amazon, I do like Google for the valuations right now, as well as the future and going forward. So, I would pick them up before the stock split if you like them, because it is, a very marginal net positive on those. It's a safe investment going forward. So is Alibaba good? So B Charan wants to know if Alibaba is a good buy now. I like Alibaba. I've talked about it last week. We had a video last week. I put a little over $8,000, actually a little under $9,000 in the stock before the big boost. I think my cost basis was right around $80 a share, up about 35% over the last week, but I think it still has lots of room to run. Again, I think the Chinese government made that pronouncement that they are going to back off the regulatory crackdown. They are stimulating the economy with lower rates and really trying to boost the economy after the real estate sell-off that they had, at the beginning of the year. The Chinese government, no government likes to backtrack on what it says, okay? And even more so the Chinese government. If they make a pronouncement, it's going to stick. It's going to be something that they stick with, even if it was a bad decision. They're going to stick with it for quite a while and try to let it to play out. So the fact that they made that pronouncement, I think the pressure is off of these Chinese stocks here. I wouldn't go jumping into a lot of them because, there are still regulatory risks. There are still delisting risks for a lot of these, but especially over the next year, I think you can do very well. And some of these very big, strong Chinese companies like Alibaba is actually my favorite there. So I would look at that. Okay. Beginner. Absolutely. Depeche, love your content, inspire me so much to do better. I appreciate that, man. I really try making this channel something different, teaching you the why of investing. And I know sometimes the videos go kind of long, 15, 20 minutes on the videos because, I'm not going to just give you a list of stocks to buy. I can't just say, hey, buy Amazon, PayPal, SoFi, Teladoc, things like that, right? Because that does nothing for you. That keeps you dependent on some Yahoo on a bow tie on YouTube or, whatever channel you're watching. That's just basically keeping you dependent on that channel to feed you stock picks. And that does nothing for you. It actually sets you up for a lot of scams and a lot of bad investments if some YouTuber just wants to, force feed you what they're investing in, which is totally the wrong way to go. So, I try to kind of interlace in those stock pick ideas, the why of investing, the why of investing in those specific stocks, kind of a theme, as well as those stocks themselves. So, thank you for bearing with me on that. I'm trying to make you a better investor. So, someday we can all retire rich and know exactly what we're doing when we're picking stocks here. I've seen a couple of questions on Funko. This is a stock I haven't really watched lately, but I am going to talk about it because it was one of the first comments. One of the first people here in the chat came in to ask about Funko. So we can look at that real quick. Again, I haven't looked at it real quick very much. They're a leisure retailer company, and it's really weird. It says a pop culture consumer products that designs, sources, and distributes licensed pop culture products. Okay, U.S., Europe, internationally, and really, so what this is, they're really licensing the name and the brand for a lot of things. Action figures, fashion accessories, bags, backpacks. What kind of worries me here is they're in so many things, t-shirts, hats, board games, plush products, plush toys, so a lot of just retailer things, right? So a couple of things you gotta look at if you're investing in Funko. One thing is just that overall consumer environment. Okay, going to be very important for Funko that the consumer stays strong, consumer spending heads higher, right? And like we've seen, like we've talked about, I think that theme or that thesis does come into question, especially as we see inflation head higher. Over these next couple of months, you're going to start seeing consumer sentiment surveys come down. So surveys where the consumer is a little bit more worried about gas prices, about inflation, things like that. That is going to weigh on these consumer discretionary stocks. You're going to start seeing actual spending probably come down a little bit. That's going to weigh on the stocks. So that's kind of the broader, that larger macro idea when you're looking at consumer discretionary and a stock like Funko. Then you got to go one step further. You got to go into the company itself and say, okay, where is its pricing power? Where is its brands and the things it's licensing? Okay, so that's when you go here to like the financials and you look at what we talked about, the gross profit, the gross margin, and the operating profit, the operating profit margin. Okay, so you look at that profitability, see how it's been able to handle inflation. Watch the Q1 earnings report they have coming up and see what they say about inflation and their products. You want to follow their brand. their market share for each product and things like that. And that's really where it becomes kind of difficult for Funko, because they do sell so many different kinds of products, from hats and bag, purses and shirts, apparel, and plush products. So many different products that you really do have to have a good idea of, where that brand value is. Now, if you do look at the valuation on it, it's not terribly, it's not expensive. Okay, price to sales of 0.6 times is basically where a lot of retail names are trading right now. So one thing you can do is you can compare it to a lot of retailers, apparel, toys, like Hasbro and other retailers. You can compare it on the valuation on that, and it's not expensive. Price to sales of 0.6, trailing PE, so price to earnings ratio of 15. So not expensive. So if you really do think the consumer is going to be strong, is going to continue to be strong, because that's what we talk about a lot on the channel here. And it's really how I like to invest, is start with that top level idea. Okay, those themes in the market, the economic themes, the mega trends, things like that. Start with those, okay, because that is going to be so much more forceful on all the companies under that theme. Okay, if the consumer stays strong, if the consumer spending stays strong, then all the companies in the consumer discretionary sector are going to do well. They are all very attractively valued right now. They're not expensive, just like we've seen with Funko here after the sell-off. They're not expensive. So if the consumer stays strong, all of these stocks are going to do well, whether they're the best stock in the industry or not. Okay, so you really want to start with that higher level. Vice versa, on the other side there, if the consumer falls off, if the consumer really starts getting worried about inflation and brings their spending down, I don't care what stock you are in consumer discretionary. I don't care if you're the strongest brand in the consumer discretionary sector. You're going to have a hard time, okay? And the stock price is probably going to come down. So that's why I like to start with that big picture idea, what I think is going to happen with that big picture. And then you go down into the into the company itself and kind of look at the company and whether you like it against some of the competitors in the name. So without having really dug into the actual into the actual company itself, that's about the best I can tell you on Funko right there. Kind of what to look for and how to think about that stock. Okay, what else do we have here? What about Tanger? Palantir, Facebook. Kyle wants to know about Palantir and Facebook. Palantir is actually one we've got a video on a couple of weeks ago, so check that out. I actually called it to the day on that. And in fact, the video was about really the huge selling that we saw in ARK, the ARK K. So Kathy Wood's ARK Innovation, the ARK funds sold out of all of their Palantir. Okay, they used to be one of the biggest cheerleaders for Palantir, for the company, saying, it was an innovative company. It was going to be the next best thing. And then they sold out of it. They completely gave up on it. And I really took that as the point of max fear in that company, in that stock. If even Kathy Wood, which is usually very positive and optimistic on her stocks, if she's selling out of it, then that's max fear. That's pretty much the last people that are selling that stock. So we did a video and lo and behold, it has since rebounded. Since then, it is up very, very nicely. I do like the company. It's getting a little bit more expensive after the rebound, but longer term, it is a good company. But just watch the valuation on that before you do. Facebook. I like Facebook. I know it's come down, it's burned a lot of people, but at this point, obviously, after a 30, 50, 60% decrease in the stock price over the last year, it is still the name in social media. Okay, I don't even like Facebook that much, using it as a social media platform because I'm not a social person. I tend to hate people, honestly. Just kidding. I'm only half kidding there, but I don't like social media. I don't just go to Instagram and Facebook and Twitter and spend all day and have fun on that. But I use Facebook. I have to. Everybody has to, because everybody is on Facebook. If you're a business owner, you got to be on Facebook. So there is a lot of value in that. A lot of value in that scale and that dominance of social media. Over the next couple of quarters, they're still going to see a hit in those revenues because of the Apple privacy changes. Okay, so we actually did a Facebook video a few weeks ago as well. Make sure you check that out. Go to the channel, go to videos in the top menu, and then click on that, and you'll find the Facebook video. You can search for the videos there. And really, you're going to see problems in revenue growth over the next couple of quarters because of that Apple privacy changes. But it's still a strong stock, and I think a lot of these social media stocks, they learn to get around those privacy changes. They learn to retarget customers like they used to in the past, and I think the revenues keep growing on this. So as a long term, there's pain. There's pain in it right now, and there has been over the last year. But I think this is a great time to be a long term buyer of the stock. What else? Stephen, good morning, Devil Dog. Hoorah there, brother. So gas prices are high. Yeah, my petroleum stocks are sky high. Yeah. Gas prices, and this is so OWell says I'm stuck between gas prices are high and yay, my energy stocks are sky high. Okay, this is a great way to invest, actually. Okay, so the idea here is that you invest in what you're paying, your costs. Okay, this is something I've talked about with retirement investing for a while, but it's in anything. Okay, where are your major costs for your living, for your lifestyle? Okay, so we'll talk about retirees specifically, because that's something that I've covered in the past. But as you get older, you retire, things like that, you're going to start paying a lot of money for healthcare. Okay, drugs, pharmaceuticals, just healthcare services, things like that. So if those costs are going up, why not benefit from that? Why not benefit from the extra money that you and all these tens of millions of people that are retiring every year are going to be paying for those services, right? So, as you get older, maybe start positioning your portfolio in more of the drug stocks, more of the healthcare services companies, things like that. So, if you keep paying more, then they keep making more money, and, your portfolio kind of evens out your higher costs, things like that. And what we're talking about here, obviously, is with gas prices versus energy stocks. If you're worried about gas prices really hitting your budget, invest in energy stocks, so you benefit as those gas prices go up, even if you have to pay a little bit more at the pump. So great idea there on that. This is a good learning source for option learning. So Marco wants to know what's a good resource for options investing. We've got a couple of videos here on the channel. You can go to investing, and in fact, I'll show you real quick how to do that. Because I do want you to know how to find any of the videos that we cover here on the channel. So we'll just go to the channel here. So if you go to the channel and you go to this videos tab here in the menu, and then you can search for any idea that you want. And we've got more than 700 videos here on the channel. You can find pretty much about anything. You type in options, and you're going to find this 5 option strategies. This is really the big one. This was a complete video on the 5 trading strategies that I like, from covered calls to protective puts, spreads, a lot of the option strategies I use, exactly how to set them up, how to think about options, things like that. So I would start there. You've also got some other ones, that to watch for, these option strategies to protect your money. So as the market starts coming down, some of the things that I've done to protect my own money through options trading, things to check out there. Another resource you might check out is Interactive Brokers has some options investing videos available on there. You don't have to have an account on IB. You just go there, you go to education in the menu, and you're going to see a drop down where it says videos. You can watch some of those videos there. So those are all good resources for options investing. Okay, what else? Stocks of the Ukraine war hasn't been resolved yet. So JJ, how are the stocks up if the Ukraine war hasn't been resolved yet? Well, I mean, it's not all about Ukraine, right? There are, as we've been talking about, even if you look at the market, even before Ukraine, even before Russia invaded, and before that started to flare up there in about February, stocks have been falling for the past 3 months before that, really since November. So you really look at the reason, and the reason is what we've been talking about on the channel, is that interest rate lead up to the interest rate hikes, right? Again, the market was worried about interest rates going higher. They're worried that it would slow down the economy. It was really that sell the rumor idea that we've talked about on the channel, and we got that relief rally when it actually started. Okay, when we got through sell the rumor, we started into buy the news. Okay, and so again, talked about this at the beginning of the live stream. It's really something that you can adjust in your investing strategy to make money. This is one of the few things in understanding that investor psychology, that investor behavior that creates these tendencies and these trends over and over and over again. We see that time and again before the Federal Reserve starts raising rates, the market gets worried, the market gets scared, and investors start selling out of their stocks. They sell the rumor of that interest rate hike. When that actually comes through, it's not so bad. The market sees, okay, you know what? Interest rates are a little bit higher, but a little bit higher. That's it. So they buy the news. And it's these kinds of investor behaviors, these tendencies that are so predictable and that you are going to happen. 90% chance that it's going to happen this way. And we've been talking about this on the channel where we would see that relief rally when the Fed started hiking rates. Okay, here in March last week, and that's what we got. So that's one of the things you can predict in the market. Obviously, the Ukraine situation has thrown a wrench into all of this. If it weren't for the Ukraine situation, I think the stocks would be up almost as high as they had been last year. Okay, they would have rebounded fully over the past week or two, and we would be much higher. But now we've got those inflation worries from Ukraine. We've got some geopolitical worries and things like that to really contend with. So. Okay, Deshaun wants to know if you should have more than one online trading platform because the only one I have is reinvesting my dividends. Should I have one that just pays dividends? A couple of questions there. One is, should you have more than one online trading platform? Yes. I've got 7 different investing accounts, and I'll tell you why. There's a couple different reasons. One, just to get free shit. A lot of these investing accounts, these platforms, like Webull, like M1 Finance, like E-Trade. E-Trade not so much, but Webull, M1 Finance, I know a lot of these, they'll give you free stuff just for opening an account and maybe putting $100 in it, right? With Webull, you get up to 5 free stocks just for opening and funding an account. Okay, you put $100 in there, you get $1,000 worth of stocks potentially. Most of the stocks they give you for free are right around $3 to $5. But even that, if you get 5 stocks at $5 each, that's $25. If you only put $100 in the account to open it and get those stocks, that's a 25% instant return. Plus, you still own those stocks. Okay, so get all the free shit you can, folks. You can always, keep those stocks in there. This is what I did with Robinhood when it was coming out and giving away those free stocks. I opened a Robinhood account. Started getting the free stocks in there. I didn't put any money in it. I just kept getting those free stocks, and just kept them in there. Eventually I sold the stocks and closed up that account. But get all the free shit you can while you can, okay? Because it doesn't last forever. So that's one thing. Another reason why I have so many different investing accounts is for different reasons. I use Webull for their stock simulator. A great stock simulator lets me test out strategies and ideas with paper money without investing my own real money to follow these before I do invest. I've got E-Trade for its research. You get Morgan Stanley research from E-Trade. You get a lot of tip ranks research. You get a lot of great research from that account. I've got a B of A Merrill Lynch account for that reason as well. For the research. So for some accounts, I have great research that I can use in my stock analysis. Some accounts have better retirement accounts, things like that. While other accounts have different things. They have trading. So Webull is better for trading. M1 Finance is really better, I think, for that set it and forget it, buy and hold kind of strategy where you set up your stocks, you set up your portfolio, you just put money in every month, and it's going to break up your money into each stock that you have or each fund in your portfolio equally or however you want it. And you don't even have to worry about it. You just put money in and you don't even have to look at it if you don't want to. So different platforms for different types of investing, different reasons and different uses. And there's nothing wrong with having more than one. Okay. You don't need 7. You don't need 8 like I've got, between real estate and stocks. You don't need that many, but you can have a couple. Should I... The other question here is he's got one that he just reinvests the dividends. Should he have another one of pay dividends? Don't quite know what you're asking there, but one thing that I do always recommend is having most of your dividend stocks, as many of your dividend stocks as possible in a retirement account. Okay. And so the reason here is you're not going to have to pay taxes on those dividends every single year. Okay. If your dividend stocks or your high yield stocks investments are in a regular account, in a regular taxable investing account, you're going to pay taxes on that income every single year. Whether you sell, whether you reinvest, whatever you do with those dividends, you're going to pay taxes on those unless they're in a retirement account. And then you don't pay taxes until you withdraw that money in retirement. So some good questions there. Vinny Vin, happy spring, Joseph. Thanks for everything. Happy spring. It's that daylight savings time kind of threw me off a little bit. See if we can make it permanent, but we'll see how that works out over the next couple of months. Okay, what about coin? So Cristobal Cardona wants to know about Coinbase. Talked about that. Coinbase, there is some value in it. I actually featured it in a Web 3.0 video a couple of weeks ago. If Coinbase can come out with some real plans for other products, then I think it can be a good stock. Okay, but Coinbase, they need to get a handle on NFTs. They need to get into some of these other products that are going to take their revenue diversified away from just cryptocurrency trading. Okay, because if they stay in cryptocurrency trading alone, Coinbase is a non-starter. Okay, those fees are going to come down. They have to come down. Especially compared to other platforms, Coinbase is very expensive, so it's losing people to a lot of other platforms. But just cryptocurrency trading fees in general, they're going to come down. We saw it happen in stock investing with stocks. Most platforms charge $0 to buy stocks anymore. It's going to happen in cryptocurrency eventually as well. And so you really need to be worried. You really need to be careful about Coinbase shares because until they have those other products, until they have those other revenue streams, it's going to be dangerous, for those fees. What else? Feeling bullish on Block. How do you feel about this company? Square, Block. I'm not calling it Block. I'm sorry. I can't call Square Block no more than I can call Facebook Meta. I don't know. Eventually I'll come around to it, but okay. Anyway, okay, now I know, says, feeling bullish on Square, Block. How do you feel about the company? I've always preferred PayPal versus Block, but really because they've always been similar as far as business model and what they're doing, but they're really diverging now. Okay, so it's really becoming two totally different kind of companies. PayPal is still very much more the traditional payments company, digital wallets, things like that. Block is a little bit more into that Web 3.0 idea and some of those other technologies. Like a lot of these Block, I'm starting to come around. It could be a very good Web 3.0 company. Jack Dorsey is all in on Bitcoin and Web 3.0, and he's going to grow the company into that direction. Valuation is what worries me. I would check out the valuation to make sure it's not too high. Actually, I think it is. I think it is coming down quite a bit lower. So I like the valuation here. Let's check that out real quick. To see where Block is trading. I actually think it is pretty good price to sales at this point. So I would, if you like the direction, okay, so it's down 6.8% today. Obviously a profit taking from last week. I mean, it was up big last week from about $95 up to 140 almost. 140. So you had a good 40% run last week. So you expect some profit taking as you would in a lot of these stocks after last week. But if you look at the price to sales, so here price to sales of 2.9 times, not bad. That is not bad for a growth stock. They are growing sales by 29%. So definitely still that growth stock theme. If they're any company that's growing their earnings, growing their revenue or sales, by 20, 30% plus a year, that is a growth stock. They are growing very quickly. And again, Jack Dorsey, he is all in on Web 3.0, only valued at 2.9 times on a price to sales. So, I mean, this is a company that, I think you can get behind if you really like the direction it's going with a focus on that Web 3.0 theme, on some of those other things. I think digital wallets is going to be huge. That's really why I'm investing so much in PayPal right now. I think the digital wallet space for PayPal and Block for Square here is a really underappreciated, and what they're going to be able to do over the next 5 to 10 years. So, I do like Block or Square for that reason as well. I'm going to take a couple more questions here, see what I got here in the chat. Had probably the worst luck with this thing. Keep dumping money in right before big drops. Sean, you got, I mean, that's something that we all do. Okay, so Sean says, what would you suggest someone that's been investing for 5 years is probably the worst luck with this kind of thing? Keeps dumping money in right before the big drops. I mean, the last 5 years have been crazy, but this is something that really we all have to go through as far as as far as learning and how we invest. Okay, if you're only investing on the big thing right now, okay, the big thing, the big growth stock, or the stock everyone is talking about, okay, you got to understand, by the time you hear about it, by the time I hear about it, by the time just about anybody hears about it, it's already popped, okay, right? They're talking about it because it has popped higher, okay? So if you're just going to YouTube and, investing in the first big stocks that you hear and the stocks that a lot of these other channels are, oh my God, look at the stock chart, it's going crazy, buy this stock. And that's their entire investing strategy, folks, okay? I mean, it has just made me fucking insane over the last 2-3 years. Okay, honestly, it has driven me crazy that a lot of these other investing channels, their whole investing strategy is to show you a stock chart of something, just finger pouring it up and say, oh my God, look at how this stock has done. That's what I'm buying. How is that an investing strategy? I mean, there is a such thing as momentum investing, but it is a lot more detailed, a lot more intense than just looking at a stock that's gone up, buying that. Okay, honestly, folks, that is not how stock investing works. You can't just invest in a stock because the price is going up. Because as you've seen, bud, you're gonna get burned, because you are eventually going to be the last one holding that stock as everyone else takes their profits and sells out. Okay, so you really got to do that longer term investing. Figure out the companies that you really like, that are good valuations. Okay, something I've talked about a lot on the channel is my rule for not investing in a stock that is trading over 10 times on a price to sales basis. Even those crazy growing growth stocks, okay, stocks that are growing 30, 40, 50% sales each year, I'm not paying more than 10 times on a price to sales basis, okay? Because it is just a signal, a sign that the market has just gone crazy with investing in these stocks, is paying way too much for these stocks. And that's what we've seen over the past year. These growth stocks have come down from 20 and 30 times on a price to sales basis down to under 10. And I can finally start getting excited about them. Okay. Because, you don't want to be one of those people that is just investing with the crowd. Okay. So you gotta have a little bit of valuation mindset. You gotta be in it for the longer term. I do know it's painful to see a lot of those stocks come down, but you gotta forget about what's in the past. Okay, whether you've lost 20 or 30 or even 50% in a stock doesn't matter anymore. Okay, that money's gone. If you sell now, you lock in that loss. If you hold it, but and this is important, you got to reevaluate what the future is for that stock. Is it now at a good price? Is it now at a good valuation? Whether you've lost 50% or not, if that stock is now at a good valuation, if that stock is now a buy because of that future that it has, then you keep that stock. Now, on the other hand, if it's still a little expensive, if it's still a little expensive and the future sales growth isn't that great to really keep you in that stock, if you wouldn't buy it right now, then sell it. Take the loss. It's probably gonna be dead money anyway. Take the loss, put it in a stock that you do like. Okay, you gotta evaluate every stock as if it was the first time you're seeing it. Okay, whether you lost 50% or whether it's a new stock you're just now watching, you got to evaluate it as a new stock right now. What's the valuation right now? What's it looking like in the future? So great question there. And I'm actually going to cut this off. We're about an hour and a half into the live stream. Thank you for joining me. I appreciate it. Each Monday, 9 a.m. Eastern, getting you ready for the stock market, for the stock market week. Go ahead and look for that link in the chat above. I'll put it in the description below as well. Check out our mastermind group, limited to 15 people for this first 3 months. So definitely check that out if you're interested in that. And thank you, and I'll see you in the next video.